I've been saying for the last couple of years, at some point, we're going to have a recession, but I don't see it coming. The signs we have from our companies, we own 275 companies. All of them around the world seem to be doing pretty well. We think the economy is in reasonably good shape and can take 2 more 25 basis point increases this year without any real disruption.
I do think the market is highly valued, but when I look at the implications from that, I think it limits more the upside in the rest of this bull market. The real risk is if the cycle ends. That's where the negative return potential comes in. Half of the bull markets in post-war history have, more than half actually, have ended when the real yield fell to the lowest quartile.
Yeah. 2-year note has moved as much as it's moved, and why it's at a 10-year high is because the Fed is, relative to the rest of the world, normalizing rates aggressively, and the 2-year note is the most sensitive along the Treasury curve in responding to those Fed expectations. Yield curve, with one exception, 1966, 2s, 10s, or has basically predicted every recession. If the curve inverts, let's say in October, history would say the earliest you'd have a recession would be next summer, next August, and the latest would be August of 2020. Now, it's possible that this time is different and the curve might be sending a bit different signal because long rates are relatively low.
We do expect to see a slowdown at some point. I don't think that's going to be happening during the course of this year, but certainly the odds are rising in favor of that happening during the course of 2019. And that's even more likely if the tariff issue remains on the table with no deal.
I think the trigger could very well be higher interest rates. Our economy is still being juiced up by these very low interest rates. Productivity has not been really picking up. I think if you do get like a pickup in interest rates, to where the 10-year does get to the 3.5–4% type of level, that will be a drag on the economy.
The idea that you're inevitably going to have a recession just because you've had an expansion for a while is not really right. Australia is a country, for example, that has not had a recession in a long time, 25 years or more. The U.S. expansion, the growth rate has been very slow since the financial crisis. It's picked up some recently, but it's generally speaking been very slow. So the level of output is actually quite a bit below where it would be if you had a more normal expansion. So that augurs for the idea that maybe the expansion can go on for a while.
My sense is that when the Fed has gone too much in previous cycle and has inverted the curve in the process by raising short rates too far, two conditions have been met when that has happened. One is obviously the yield curve inverts. You also have the Fed putting its policy rate well over what is, the so-called natural rate, R star as we call it, 200 to 300 basis points. You think about the current cycle, the 3-month to 10-year curve is about 100 basis points, give or take 10 basis points. That would require 4 more hikes at least. If and when the curve inverts, it will be at least a premature signal, let alone maybe a false positive.
Cumulative growth has not been that high. So in a way, if you think about it, most recoveries were much faster snapbacks that then had a fall. So if you look at the cumulative growth rate, we got one of the slowest recessions on record.
Why do you think that is?
Regulation. I think we swung the pendulum really hard toward regulation. We slowed the economy down. I don't buy secular stagnation. I call it secular stagulation. And I think we had a lot of things that hindered investment, that hindered economic activity, and the usual drivers of growth, which are an investment cycle. A lot of those are being pulled back in the last 18 to 24 months. And what we're seeing is a huge change in investment.
Globally, there's a lot of unusual action still. There's a global normalization that's going on, and the more that can be predictable and understandable, the better it will be. So far, it's been good for the markets. I think you have the U.S. economy is looking good. It's partly because of this adjustment of policy. I think the tax cut and the regulatory changes are part of that as well. But monetary policy is by no means insignificant in this improved economy.
I'm still optimistic about the performance of the market for the full year. I don't think there's any recession in sight. I think the situation in Turkey is serious for the moment, but I don't think it represents systemic risk. So I think the market was overbought and overdue for a correction. We're having a correction. Turkey is the trigger. I think it's going to represent a buying opportunity.